Welcome to another presentation of Capital Economics. The title of today's presentation is "The Fed is Buying Everything," and I'm sure many of you who are aware and paying attention to the news, in particular the financial news, you are well aware of what is taking place at the Federal Reserve and within our federal government as well. Well, the hits just keep on rolling. It's one emergency facility after the next. It is alphabet soup. It'll make your head spin with all of the facilities, the emergency facilities that the Federal Reserve is rolling out. A lot of these facilities were in existence and were used during the depths of the great financial crisis. Of course, they were put into a drawer somewhere within the Federal Reserve, and now they are dusted off and they are back in action. And of course, they are creating more as we make our way through what is likely going to turn into a depression. I hope I am wrong about this, but if you follow the money, if you understand the mathematics and the economics of this, if you understand the history, if you understand the likely social and behavioral changes that are going to ensue following the quote-unquote reopening of the economy, whenever that's going to be, these changes will be drastic. There is not going to be a return to quote-unquote normal, nor should there be, because normal was not sustainable. The Federal Reserve is going across the board when it comes to financial assets. They are involved in the repo market, which they have been for quite a while. They are basically the buyer and seller in that market. They are heavily involved, obviously, within the US Treasury space across the entire yield curve. They remain heavily involved in mortgage-backed securities. That was typically involving residential. Now they are dipping their toes into commercial real estate as well. And for those of you who follow my podcast as well at the Capital News, understand this well. We have been warning about this since this podcast has been online for well over a year now, that this, when it comes to real estate, is going to be a top-down, bottom-up squeeze. That is what we are witnessing. And this is just the tip of the iceberg. The Federal Reserve understands this. That's why they are now getting involved in the commercial real estate side as well. They are also getting involved with purchasing from the primary market and on the secondary market investment-grade bonds and whatever they want to deem investment grade. Okay? Then it comes to pass today, that the Federal Reserve is going to open up the floodgates, open up the spigot, whatever you want to say, once again, and come up with another $2.3 trillion. Out of nowhere, they're just going to print it for other lending facilities and to get involved in the junk market. The investment-grade bond market wasn't enough. I guess those high-yield junk bonds felt lonely, and the Federal Reserve felt bad for them. So they said, no, don't worry, we're going to come and take you home too. So now the Federal Reserve is going to be pretty much buying up the corporate bond space. No end in sight. The only thing that the Federal Reserve has yet to really start purchasing is U.S. equities, and that is because they are prohibited from doing so within their charter. They're really not even allowed to be buying other debt either. They have to buy debt. According to their charter, they have to purchase debt, or they can purchase debt if it is guaranteed by the government. Well, corporate bonds aren't backed by the government. Treasuries are. Now, because of Fannie Mae and government-sponsored enterprises, you have mortgages that are mortgage-backed securities, so technically they can get into that space, but they're not supposed to be involved here in the corporate bond market. But never let a crisis go to waste. Isn't that what they tell us? Well, they wasted no time, because what took the Federal Reserve months last time during the great financial crisis to sort of figure something out and come up with this asinine policy, an asinine economic experiment in which we've been living in for the past decade of quantitative easing, well, now they say, we got the playbook. Now let's just take this into overdrive. And that's what we're seeing. And what we're witnessing right now is the Federal Reserve's balance sheet on the asset side of the ledger, because their liabilities are the Federal Reserve notes. You know them as U.S. dollars. Take one out of your pocket, look at it, it says a Federal Reserve note. That's their liability. That's what they're responsible for. And of course, if there's ever a problem, they'll just print them up. But what gives any type of currency its credibility And for people and businesses and countries to exchange in that currency, there has to be some sort of faith, trust, confidence within it. So it has to be backed by something. Of course, this is complete fiat. It is not backed by gold or silver or any other type of commodity or a basket of commodities. It's backed by the faith and credit of the United States of America, which has $24 trillion in a national debt, is going to have a national deficit of $2, $3, maybe $4 trillion because we don't know when all of this money spending that the federal government doesn't have is going to end. We have no idea. And the further and deeper we go into recession, perhaps depression, the worse that deficit will be. Because we have a government that believes it is the job, it is the role, it is the function of government to step in to be somebody or an institution that offers demand to the market. Even if Uncle Sam is as broke as a broke, and he is broke as a joke as he is, doesn't matter. We'll go to the Federal Reserve, they'll buy everything. That's what we're talking about. The Federal Reserve is buying everything. So here, this chart is updated every week, once a week on Thursday. Okay, this is the asset side. You can find this on their website, FRED, Federal Reserve Economic Data. You type in assets, it'll be the first thing that pops up, and you look at it. And what do we see? We see a Federal Reserve, a central bank that has been out of control and remains out of control. Now, this data that we're looking at goes from 2002 to current day, okay? Extremely updated. We are now slightly north of $6 trillion. So you have to take this and look at this in perspective. Well, that's why we have data going back to 2002. And you could really take this back and look at the history pretty much since the inception of the Federal Reserve, coming into existence in 1913, opening its doors in 1914. So you basically have almost 100 years from 1914 all the way up to 2007, 2008, in the depths of the great financial crisis. And you have a balance sheet at the Federal Reserve of about $800 to $900 billion. Then, seemingly overnight, in the depths of the great financial crisis, former chairman of the Federal Reserve, Ben Bernanke, and his minions come up with the idea of quantitative easing. Let's just print the money. Let's just see what we can do. Let's print the money. Let's buy assets. Let's see what we can get away with. Well, the markets bought it. They said, well, they might come up with something. These people seem smart. They might know what they're doing. And so it sort of brought some calm to the market. So everybody thinks, oh, quantitative easing is some sort of economic panacea. Okay, until, of course, it wasn't. There's rumblings. There's corrections. The markets don't like it. Federal Reserve panics. We're in the depths of the great financial crisis. We can't go down again. Markets throw a tantrum. They throw a hissy fit. Worry not. Quantitative easing takes us from 800, 900 billion north of 2 trillion. Not a problem. Don't worry about it. You throw your tantrum. You throw your hissy fit, which is what they did. Quantitative easing number 1 wasn't enough. Okay, let's ignite quantitative easing number 2. You get this step-like pattern. That wasn't enough. Excuse me. That wasn't enough. Why? Because it's never enough. Another tantrum. Operation Twist. Remember that? Operation Twist. I don't know what they're doing. They think they're dancing. I don't know. But Operation Twist came about. That wasn't enough. Why? Because it's never enough. Then you got quantitative easing number 3. Big step, and then it starts to taper off. Remember, and you had the taper tantrum somewhere in here. And then, of course, you start to see this leveling off after it tops out at about $4.5, $4.6 trillion, and it levels off for a few years, right? Then you get the tail end of the Obama administration. You get the Trump administration coming in. And, of course, we're told the repeated story. This is the greatest economy ever in the history of mankind. There are no bubbles anywhere. There are no overvaluations. Everything is humming perfectly, which, of course, is not true, was not true, remains untrue. So the Federal Reserve had it amongst them. They said, well, you know what? If everything is great, this is the time to start normalizing our balance sheet, whatever that means. But at least conceptually, you would think that that means, okay, we're going to start tapering, which is what they did. You start to see this decline. Normal, I have no idea what normal is. Does that mean they're going to take it down to 3 trillion, 2 trillion? I mean, try to take, this old line as some sort of historical evidence, some sort of historical trend, and just sort of extrapolate it out over the course of this time. You say, oh, well, maybe, just maybe, if things just sort of continued, we'd be somewhere around here. Maybe about 2 trillion. If we want to be nice to them and say, okay, well, you can hold more assets, 2.5 trillion. We didn't even get close. Why? because the markets threw a tantrum. They threw a hissy fit. Remember the fourth quarter of 2018, you had that massive sell-off in equities, right? Wall Street, markets throw a tantrum. The President of the United States throws a tantrum. You can't do this. And remember, the chairman of the Federal Reserve, who is still the chairman of the Federal Reserve, Jay Powell, said, you know what, this taper, it's on autopilot. The economy's humming along. Everything is good. Unemployment is low. There is no inflation. Everything's perfect. Now's the time for the Federal Reserve to normalize our balance sheet. Markets didn't like it. President didn't like it. A complete about face. Stop in the tracks. Then you had, okay, now we're going to start cutting interest rates again. Boom, boom, boom. 1, 2, 3, they did it. Have to get involved in the repo market. Whole bunch of things start shaking. The foundation is starting to crumble. And what was on autopilot just a couple years ago turned into this. Off to the stratosphere with a convenient backdrop of a global pandemic. Never let a crisis go to waste, right? So we get this down to about $3.7 trillion here. Can't have that for too much longer. Spike it up, which is sort of, it really is basically a one-to-one relationship with what took place in the melt-up in the equities market. All of that liquidity being thrown onto the balance sheet here. The Federal Reserve, its balance sheet growing, that's liquidity being thrown into the market. And you had that massive run-up, that massive melt-up that came tumbling down, crashing with such rapidity, 30, 40% decline in a matter of weeks. And then this, all of the panic. The Federal Reserve has to buy everything. The alphabet soup of facility, one after the next, after the next. Remember, in some of these emergency meetings only a few weeks ago, they said, yeah, we're going to implement another version, another round of quantitative easing, $700 billion. Well, we told you, folks, and you can look this up in one of our first, maybe our first, capital economics presentations, I think it was back in July of last year, where we asked the question, are central banks trapped? And we looked at this very graph. We looked at the graph of other central banks. And we said, if they're going to continue with this insanity, they're going to have to do so at warp speed. And that's exactly what this vertical takeoff is. This is a rocket ship into the stratosphere, just above $6 trillion. And this is just the tip of the iceberg. We are just getting started. So look at this from a perspective. To put this into context, look how big of a rise this is. So you're down here around 3.7 trillion. Now you're north of 6 in the span of a few short months. They have just expanded their balance sheet by over $2 trillion. And this will continue. This will continue because, unfortunately, we also got the news out today that another 6.6 million Americans filed for unemployment benefits. So over the past 3 weeks, almost 17 million, it's north of 16 million Americans have filed for unemployment. And that doesn't count. That does not count the Americans who filed during this week, and we'll find out those numbers next week. And this does not count the number of Americans who are already unemployed prior to all of this. So these numbers are going to be very close to the Great Depression. They could very well exceed it during the Great Depression of the 1930s, where that peaked out at about 25% on the unemployment rate. So within a few short weeks, we could already be getting to those numbers that we have not seen in 100 years. And that was during the depths of the Great Depression. Just for a little bit of context, a little bit of perspective as to what's taking place here. All of these shenanigans, this asinine, fraudulent, criminal economic policy and experiment of quantitative easing, number 1, 2, and 3, Operation Twist, did not work. Led us to economic ruin, which is what we're in the midst of. This is what we are witnessing. What COVID-19 was and is the pin that pricked the everything bubble. It is the trigger that is now showcasing to the world how weak so many corporations and households were and are. This is a travesty. And the knee-jerk reaction from the federal government and the Federal Reserve is to buy everything. You know, the Federal Reserve, by their charter, is basically supposed to be the lender of last resort. Well, now, not only are they lending money to everybody, they're now buying everything. They are the lender of last resort, maybe first resort. And they're the buyer of last resort, maybe first resort. And the hits just keep on coming because there are some mumblings going on out there that the Federal Reserve might have their charter amended by Congress. It would have to be an act of Congress to purchase equities outright. And there are a couple central banks out there around the world who can do this. The Federal Reserve currently is not one of them. Of course, a lot of people already think that they are. And really, I mean, they might be, but just through a middleman. There is no end in sight to this, unfortunately. They think for some reason that this is the right policy. But as you can see, this is diminishing marginal returns at work. It takes more money printing to get the same sort of economic output, the same sort of outcome that they are looking for. In one of our most recent podcasts on the Capital News, at thecapitalnews.com, was titled Free Was Never So Expensive, and I suggest and ask that you check that out and give that a listen. Because the American people are in for a very, very, very rude awakening because there is no free lunch. There are consequences to this money printing. There are consequences to federal deficits, national deficits that are going to be in the $2, $3, $4 trillion range by the time this is all said and done. Who knows? There are consequences to running up a national debt of $24 trillion and counting. There are consequences to making promises for pensions and Social Security with realizations that are not coming true. This is one thing after the next. The hits just keep on coming, which may very well be why the Federal Reserve is buying everything. Is it justified? In my opinion, it is not. You may disagree, but nevertheless, these are the facts of the case. We have a Federal Reserve apparently buying everything. And as of this week, April 10th, their balance sheet is north of $6 trillion. Straight up, as you can see. So we will continue to keep you updated on this balance sheet and any other type of bailout program, quote-unquote stimulus that the Federal Reserve rolls out, that the federal government rolls out, or anybody else for that matter, because this is important stuff. It might be boring to many, but it is important. Everything is interconnected, and you will be paying the bill one way or another. Thank you so much for joining me on this presentation of Capital Economics. Please like, share, and subscribe. Check us out at thecapitalnews.com, our YouTube channel, The Capital News, also Apple Podcasts, or follow us on Twitter as well. You can also support us by buying our book, The Cynic's Guide to Investing in the Era of Too Big to Fail, It Pays to Be a Cynic. This book was published in 2015, highlighting what was taking place then, what was likely to transpire, and also gave you an inside look as to where we are today. And the continuation of that book is this very podcast, The Capital News. So please take the time. It's most definitely worth it. It's an investment. It's something that you can look at time and time again. It explains the economy. It explains investing. It explains the financial markets. It explains trends and demographics. And it connects the dots for you. It truly is a guide, and it's something that I think should be on your bookshelf. Buy it for yourself. Buy it for your kids, your grandkids. Have a conversation about it. The Cynic's Guide to Investing. Thank you so much. Again, please like, share, subscribe. Stay diversified, stay vigilant, and stay with the Capital News. Godspeed.